Preparing for a financial analyst at L'Oreal interview, you've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at L'Oreal? I want to join L'Oreal because it combines strong financial discipline with a dynamic, brand-led consumer business. A financial analyst can influence pricing, marketing investment, product launches, and regional performance rather than simply report historical numbers. I'm particularly attracted to the company's international scale and focus on innovation. My strengths in financial modeling, variance analysis, and communicating insights would help managers make faster, better decisions while allowing me to learn how beauty brands create sustainable growth. While answering, connect your analytical skills with L'Oreal's global brands, innovation, premiumization, geographic diversity, and consumer-driven business model. Show genuine interest in turning financial insight into commercial decisions. Question 2. How would you analyze L'Oreal's revenue performance? I would begin by separating reported growth from like-for-like growth, then bridge revenue by volume, price, mix, currency, acquisitions, and disposals. Next, I would compare performance across divisions, brands, countries, channels, and product categories. For example, growth led by price increases has different implications from growth led by units sold or premium mix. I would also reconcile the analysis to management reporting and investigate unusual movements before presenting the key commercial drivers and risks. Make sure to cover reported and like-for-like growth, volume, price, mix, geography, division, channel, currency, and acquisition effects. Explain how you would reconcile management commentary with detailed financial data. Question 3. What financial metrics would you monitor for a beauty and consumer products business? I would monitor like-for-like sales growth, gross and operating margins, market share, advertising and promotional efficiency, inventory turns, working capital days, cash conversion, and return on invested capital. I would disaggregate those measures by division, geography, brand, and channel because consolidated results can hide underperformance. For a beauty company, I would also track innovation contribution and premium mix. The strongest dashboard combines financial outcomes with operational drivers, helping management distinguish temporary volatility from structural performance. In your answer, talk about sales growth, like-for-like growth, gross margin, operating margin, market share, advertising efficiency, inventory turns, receivables, cash conversion, and return on invested capital. Question 4. How would you prepare a monthly management reporting pack? I would start by validating actuals against the general ledger, prior submissions, and operational data. Then I would prepare concise views of sales, margin, expenses, cash flow, and key business KPIs against budget, forecast, and prior year. Commentary would explain drivers, not merely repeat variances, and would identify actions, owners, and timing. I would tailor the pack to senior management, check materiality and consistency, and discuss unusual items with local finance and commercial teams before finalizing it. Be sure to mention data validation, actual versus budget analysis, relevant KPIs, driver-based commentary, materiality, visual clarity, action-oriented recommendations, and review with business stakeholders before distribution. Question 5. How do you investigate a significant unfavorable budget variance? First, I would confirm the variance is calculated correctly and understand whether it is a timing issue, forecast error, accounting classification, or genuine performance gap. I would decompose it into volume, price, mix, currency, cost, and one-off effects, then speak with the responsible commercial or operational owner. Finally, I would assess whether the issue changes the full-year outlook, document the root cause, and recommend a specific corrective action rather than simply reporting the unfavorable number. Focus on confirming the calculation, decomposing the variance into price, volume, mix, timing, FX, and one-off effects, speaking with owners, assessing forecast impact, and proposing corrective action. Question 6. How would you build a sales forecast for L'Oreal? I would build the forecast from operational drivers, units, average selling price, product launches, distribution, promotion, seasonality, market growth, and expected currency movements. I would review historical trends but avoid extrapolating unusual periods without explanation. Assumptions would be validated with sales, marketing, and regional teams, then organized into base, upside, and downside cases. After each close, I would compare forecast to actual results, quantify forecast error, and refine the drivers causing the largest misses. Mention historical trends, category and regional assumptions, product launches, promotional calendars, distribution, market growth, seasonality, FX, scenario analysis, and regular backtesting against actual results. Question 7. How would you explain a change in gross margin? I would bridge gross margin from the prior period using price, volume mix, product mix, input costs, manufacturing efficiency, freight, promotions, and foreign exchange. A stronger premium mix or successful pricing action may expand margin, while raw material inflation or heavier discounting may offset it. I would also check inventory provisions and purchase price variances for accounting effects. The conclusion should distinguish sustainable improvements from temporary benefits and connect the margin movement to operating profit and pricing decisions. Cover pricing, product mix, raw material and packaging costs, manufacturing efficiency, freight, promotions, foreign exchange, inventory provisions, and the difference between temporary and structural effects. Question 8. What is price-volume mix analysis and how would you use it? Price-volume mix analysis explains revenue movement by separating changes in units sold, selling prices, and the composition of products or markets sold. I would calculate the bridge using consistent units and isolate mix carefully because selling more premium products can improve revenue without increasing total volume. I would use the result to evaluate pricing actions, promotional effectiveness, and portfolio shifts. Linking the bridge to margin is essential since favorable revenue mix may carry very different profitability. Make sure to define the bridge clearly, distinguish price and mix effects, use units and revenue data consistently, and explain how the analysis supports pricing, portfolio, and commercial investment decisions. Question 9. How would foreign exchange affect L'Oréal's reported results? Foreign exchange affects L'Oréal through transaction exposure on purchases or sales and translation exposure when local subsidiaries are consolidated. I would compare reported growth with constant currency growth to separate operational performance from translation effects, then review hedging and major currency sensitivities. A weaker local currency can reduce reported revenue while the subsidiary performs well locally. I would clearly distinguish that presentation effect from genuine commercial deterioration and explain any margin or cash flow consequences to management. In your answer, discuss transaction and translation exposure, constant currency reporting, local versus reporting currency, hedging, sensitivity analysis, and the distinction between economic performance and accounting presentation. Question 10. How would you assess the return on a marketing campaign or product launch? I would compare incremental contribution profit with the campaign's media, promotional, sampling, and launch costs, using a credible baseline for expected sales without the investment. I would adjust for cannibalization, timing, inventory build, retailer loading, and repeat purchases. Where possible, I would use test and control markets or pre- and post-campaign comparisons. I would not judge success on revenue alone. I would assess payback, brand health, customer lifetime value, and whether the investment supports profitable, sustainable growth. Discuss incremental sales and profit, baseline demand, cannibalization, launch costs, media and promotional spending, customer lifetime value, timing, control groups, and post-campaign measurement. Question 11. How would you analyze profitability by brand, channel, or customer? I would begin with gross to net revenue, deducting discounts, returns, rebates, and trade spend, then subtract product costs, logistics, marketing, and other directly attributable expenses. Shared overhead would be allocated transparently, with contribution margin shown separately from fully loaded profit. I would compare brands or channels using consistent definitions and investigate whether premium pricing offsets higher acquisition or distribution costs. The analysis should identify where incremental investment creates the strongest profitable growth, not merely rank accounting margins. Focus on net sales, discounts, returns, cost of goods sold, marketing allocation, logistics, trade spend, overhead methodology, contribution margin, and avoiding misleading comparisons caused by allocation choices. Question 12. L'Oréal's sales are above plan but operating profit is below plan. How would you investigate? I would first reconcile the sales and operating profit variances through a profit bridge. Potential explanations include unfavorable product or geographic mix, discounting, higher media investment, input cost inflation, freight, wage increases, overhead underabsorption, foreign exchange, or one-off charges. I would compare actual spending with approved plans and assess whether the additional investment generated future demand. Then I would separate timing effects from structural margin pressure and update the forecast with clear actions, sensitivities, and accountable owners. Be sure to examine gross margin dilution, product mix, promotional spending, marketing investment, inflation, freight, overhead absorption, FX, one-offs, and whether the variance is timing-related or structural. Question 13. What working capital issues would you monitor in a beauty products business? I would monitor inventory days, aging, slow-moving and obsolete stock, receivable days, payable days, and operating cash conversion. Beauty businesses need enough inventory to support launches and retailer availability, but excess products can become obsolete as packaging, formulas, or consumer preferences change. I would analyze working capital by country, channel, and product lifecycle, investigate unusual builds, and coordinate with supply chain and sales. The goal is to release cash without creating stockouts or damaging customer service. Mention inventory aging, launches and obsolescence, receivables collection, retailer terms, payables, seasonality, service levels, cash conversion, and balancing availability with excess stock risk. Question 14. How would you improve the reliability of an Excel-based financial model? I would separate inputs, calculations, and outputs, use consistent formulas, and document the source and rationale for each major assumption. I would add checks for balance, completeness, sign errors, unusual movements, and forecast-to-source reconciliations. Version control and protected formulas would reduce accidental changes, while scenario switches would make assumptions transparent. Before sharing the model, I would test edge cases and ask another reviewer to challenge both the mechanics and the commercial logic. Talk about clear input, calculation, and output sections, documented assumptions, consistent formulas, error checks, version control, independent review, data validation, and scenario flexibility. Question 15. What internal controls are important in financial analysis and reporting? Important controls include segregation of duties, documented approval thresholds, reconciliations between reporting systems and the general ledger, controlled journal entries, access restrictions, and review evidence. For spreadsheets, I would use protected formulas, defined owners, version history, and independent checks. I would preserve source data and assumptions so results are reproducible. If I identified an exception, I would assess its materiality, escalate promptly, correct the issue, and help strengthen the process rather than only fixing one report. In your answer, cover segregation of duties, reconciliations, approval limits, data lineage, journal review, access controls, evidence retention, spreadsheet governance, and escalation of exceptions. Question 16. How do accounting principles affect a financial analyst's work at L'Oréal? Accounting principles determine when economic activity appears in reported results, so I need to understand accruals, revenue cutoff, inventory valuation, depreciation, leases, provisions, and capitalization policies. For example, an expense may be incurred operationally but recorded later through an accrual or provision. I would reconcile management views with international financial reporting standards-based reporting, identify timing effects, and explain them separately from underlying performance. That discipline prevents misleading conclusions about profitability, forecast accuracy, and cash generation. Mention accruals, revenue recognition, inventory valuation, depreciation, leases, provisions, capitalization, cutoff, and the importance of distinguishing accounting timing from underlying business performance. Question 17. How would you evaluate a capital investment or supply chain project? I would estimate incremental after-tax cash flows, including the initial investment, working capital needs, operating savings or additional revenue, maintenance costs, and terminal value. I would evaluate NPV using an appropriate discount rate, alongside IRR and payback for decision context. Sensitivities around volume, pricing, costs, timing, and utilization would reveal downside risk. I would also consider strategic benefits, capacity resilience, and execution risk, because a financially attractive project can still fail operationally. Cover incremental cash flows, initial investment, working capital, operating savings or revenue, tax, useful life, NPV, payback, sensitivity analysis, and strategic or capacity considerations. Question 18. How do you communicate complex financial findings to non-finance stakeholders? I start with the business question and headline conclusion, then explain the 2 or 3 drivers that matter most. I avoid technical terminology unless it adds clarity, use simple bridges or charts, and quantify the impact in revenue, margin, cash, or forecast terms. I would distinguish facts from assumptions and explain uncertainty directly. I finish with a recommendation, decision required, owner, and timing, then invite questions to ensure the analysis is understood rather than merely delivered. Be sure to mention starting with the decision, using plain language, emphasizing business drivers, limiting unnecessary detail, visualizing trends, quantifying impact, and confirming agreed actions and follow-up. Question 19. Tell me about a time you found an error in financial data. In a monthly reporting exercise, I noticed a margin percentage moving sharply despite stable sales and costs. I traced the issue to a duplicated expense import and confirmed the impact by reconciling the source file to the ledger. I informed my supervisor promptly, corrected the report, and documented the root cause. I then added a duplicate record check and a variance threshold review to the process. The experience reinforced that careful validation and transparent escalation protect decision quality. Focus on the detection method, impact assessment, root cause analysis, stakeholder communication, correction, control improvement, and a calm, accountable approach rather than blaming others. Question 20. What would make you effective in L'Oréal's fast-paced, international finance environment? I would bring analytical rigor, ownership, and a practical commercial mindset. In a fast-paced international environment, I prioritize deadlines, clarify assumptions early, and communicate risks before they become surprises. I am comfortable working across cultures and functions, adapting analysis to local business realities while maintaining consistent definitions and controls. I also challenge numbers constructively. I verify details, understand the operational story behind them, and turn findings into actions that improve growth, profitability, or cash. Highlight ownership, curiosity, attention to detail, prioritization, collaboration across cultures, adaptability, commercial judgment, clear communication, and the ability to deliver accurately under tight reporting deadlines. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.